Guess whose mortgage is being paid by someone else for the next year while my property appreciates and appreciates? All business owners and real estate investors know that cash is king. So I was really happy when I was able to rent out this property and cash flow properly. And the passive income I get every single month is extremely nice, but it is not the reason that I invest in real estate. I invest in real estate for the long-term appreciation of my properties, and so far I have made really, really good judgment calls with the properties that I buy. And that's pretty dependent on living in Austin, Texas. I was actually born here, and I have seen the city evolve and change beyond my wildest dreams. A lot of people don't really understand why I would take on so much real estate debt. I mean, technically, I am millions of dollars in debt. But what they don't understand is that I have so much equity built up in my properties, not from paying the mortgage, but from the appreciation from the market. Historically, real estate always appreciates. Like, yeah, sure, there are dips here and there, and that's just a cycle of real estate, but historically, it always goes up. But that appreciation of real estate doesn't really mean anything unless you have an exit strategy. And so there are many different exit strategies when it comes to real estate investing. First one, you can sell. And selling is a really good option in case you have a property that's a little bit older, it's aging, you don't want to deal with all the maintenance, and you'll get a real nice check once that property closes. But of course, that is subject to capital gains tax, which is basically why in most cases I live in a property for 2 years before I start renting it out, so that if I want to sell within the 5 years of owning the property, I can do so and not be taxed on capital gains. Another exit strategy is leveraging your equity, so you can do like a HELOC or a cash out refinance or a home equity loan. All of these loan products allow you to tap into the equity of your property, and by the way, you can do this for a home that you live in yourself. It does not have to be for just an investment property. It's actually pretty common for real estate investors to take out HELOCs or home equity lines of credit against their assets, because basically you're using one property to buy more properties without selling the original property, which is nice if you're cash flowing really well. Another tax planning strategy that every real estate investor knows about is a 1031 exchange. And this is not a way to exclude capital gains tax, but it is a way to defer capital gains tax. So instead of paying capital gains tax immediately when you sell something, you defer the payment so that you can invest that entire amount of gains into something else of a like kind of property. Eventually, when you do want to take that cash home and do something with it, you will have to pay capital gains tax on it, but it is nice to defer it so that you can really take advantage of the time value of money and invest all that money now. And if you like all things real estate and real estate investing, I'm your girl.